Today on the interview with me, Ayesha Faridi, I bring you a global voice who helps shape the world's view on markets and investing. Stephen Dover, the Chief Market Strategist and Head of the Franklin Templeton Institute, leading research and strategy at one of the world's largest asset managers with over $1.5 trillion in assets across the globe. With decades of experience across equities, multi-asset strategy and emerging markets, Stephen has been a key advisor to investors navigating everything from Federal Reserve pivots to trade wars and the reshaping of global supply chains. So as the world debates whether we are heading toward a new growth cycle or a global reset, we ask Stephen Dover exactly that. Stephen, welcome to ET.
Thank you
for your time.
Great to be here.
And I want to start off with exactly that. What lies ahead for the world in this time of tectonic shift or global reset, as you call it?
Well, it's absolutely a global reset. I think that the world that was engineered after World War II, in which the United States was really protecting trade and opening free trade, is ending. And we're going to a world of probably more regional trade, a world of high technology. We just had the Nobel Prize happen just about 3 weeks ago, really talking about how the world progresses, we have to increase productivity. We have to have a great degree of creativity. But the real big thing that they said is there's a lot of creative destruction, and that's really what we're going through.
Innovation, right? Like we were talking about. That's where the seeds are sowed. Where do you think in the world is innovation happening, and who's going to lead the race eventually? I know it all emerges from the US, and it seems like it's going to be US, which has dominated so far. But then there is China, there is India, there is so many economies, so much brain power at work, innovating pretty much on a daily basis. Who's going to win the race according to you?
Well, innovation's complicated because it's individuals, it's structures that allow, especially now, structures that allow for innovation, and it's the governments that support innovations. I think, of course, there's been a lot of innovation in the US, and the US as a country has structured itself in that way. But I think there's also, if you will, a little bit of hubris in the United States, that all innovation comes from the United States or comes from the West. And what we're seeing, and I think it's a real surprise to Americans in the West, is exactly what you said, a lot of innovation coming out of China. The whole idea that somehow the West missed that if they have things manufactured in China, that China's not going to innovate and move up was a big miss on the part of the West. And India too. I think India is inherently an innovation culture.
So far, what are the signs like? Who's going to actually lead the race?
Well, I think the signs are a bit mixed. Certainly, if you were to look back over the last 20, 30, 40 years, you wouldn't have guessed the United States would be where it is. You kind of certainly went through a long period of malaise, which was a term our president used at one point in the United States. So it's been a bit of surprise what's happened in the United States. But it's also been very much a surprise what's happened in emerging markets, which when I was younger would have been called third world countries because there was just no possibility of them. I'm quite proud that my company, Franklin Templeton, and our leaders at the time were leaders in developing the term emerging markets and really leading the charge, saying these are the countries of the future. And that's where I think we're going to continue to see a lot of opportunity. Emerging markets haven't been emerging as much as we had hoped they would over the last 5 or 10 years, at least in terms of earnings. And so that's made them less positive investment opportunities than they were in the past, with India being an exception to that.
So what is going on from an investment perspective in India? Because from what I see in the last 13 months, there's been an FII exodus. I mean, you could talk about valuation, you could talk about relative plays, other countries looking cheaper, China being one such case in point, or for that matter, the earnings sort of peaked out. But what do you think will make the FIIs come back to India?
Well, I think you have to look a little beyond the 13-month story because India was so far ahead. India was such a standout among the emerging countries. So first of all, just a bias that I have and Franklin Templeton's had is that by and large we have emerging market broad emerging market funds and investment strategies. India is one of the few country strategies we have, and we've been quite bullish on India for foreign investors since I arrived. And we were one of the first companies to set up funds for retail investors to invest in India. So we are, and I think we will continue to be quite positive on the India structural story. So when I look at India, or when I'm advising foreign investors, I'm trying to look at the 3 to 5 year story.
Yeah.
So I think India kind of got ahead of itself, and then there were other relative plays where capital has gone, including the United States. And so I think that's the main story of India, and I think that will turn around as there are more opportunities in India. But I think India, in some sense, became a momentum play within emerging markets. It went from kind of being underweight to being kind of heavily overweight, more expensive relative to others, and so there was a leveling out there.
Well, when you talk about US, you think the equity dominance is going to stay? And why I ask is because there too, there is that concentration pool with the Mag 7, and a lot of concerns also around the bubble or the threat of a cool-off that it actually poses. Now with this entire Trump tirade at play, the tariff dynamics at play, the Fed finally, changing curve at play, and of course, the cool-off that you've seen in the dollar, how do you think that dynamic is going to play out for US equities?
We did a study looking over the last 50 years of every time that central banks have cut interest rates after they previously cut interest rates and the market's expanding. So that's happened 7 times in the last 50 years. Every time, 1 year later, the market has been higher. A lot of turbulence. We expect a pullback. Wouldn't be surprised. The market seems pretty fluffy right now. Wouldn't be surprised if we have a pullback of 5, even 10%. But we think in a year's time, the market's likely to be up. The other interesting part of that is risk assets do better. So we think, and that's the first thing that we have broadening, we think that it's likely that the stocks beyond the Magnificent Seven will start to perform. But importantly, and for about a year now, we've also been recommending to American investors to invest outside of the United States with our other 2 themes, that we think the yield curve is steepening and we think the dollar is likely weakening. And that's why Europe has outperformed. Emerging markets have had a good year, and as has other developed markets.
So when you say outside of the Mag 7 pool, do you also sense that that pullback could also play out for Mag 7? Because they're the only ones which are performing, and their market caps are higher than some of the country GDPs.
Well, they are. They're not the only ones outperforming, though. Actually, overseas markets have performed about as well as the Mag 7. Part of that's taking the dollar into account, of course. So for a dollar investor, and even though they haven't performed as well as the Mag 7, many different indices are also at all-time highs. So again, you have to take risk into account as from an investor point of view and say, yes, the Mag 7 probably are going to do very well, but how much risk do you want to take in that high concentration?
It's not just about a regional play here. We're talking about multi-asset classes, because what a unique time when everything from cryptos or to gold to many other precious assets, it's a multi-asset bull market that we're sitting on across the globe, right? What explains that, though?
Yeah, it's actually very difficult to explain. I think that probably one of it is that we just have a situation in which the reserve banks, in order to kind of stimulate the economy, have done that through asset inflation. And so everything's up. We see that in the consumer numbers, certainly in the United States, but I think globally. So older consumers, consumers that have assets are doing great. Consumers that don't have savings and are just trying to earn things are really hurting. We see that around the world. Again, that explains, at least to some degree, some of the political situation that many of our countries are in. The correlation of assets is troubling. And very difficult to see something that diversifies. But India, from a foreign perspective, has been a country that's had a lot of diversity in terms of its economy. India would be a country that really shows that old saying that the economy is not the markets, right? The Indian economy is really not a technology economy, but that is what, it's overweighted in the market. So that, again, argues even in India that you'd want to broaden your investment base. You'd want to pick a wider range of equities than just really focus on this narrow group that's done so well for so long and may very well continue to do well. But there's a risk involved in that.
No, I mean, the question on why multi-assets are also doing well also arose from the fact that, typically or traditionally one would think is that gold is a safe haven asset. There are geopolitical risks around the world, and maybe that's why, and of course, a lot of countries buying gold as well, piling up on that, in fact, which is why gold would be doing what it's doing right now. But then what explains the risk on mode in equities?
Well, gold's a funny asset. It's very difficult for an asset manager like me because the way I typically think is anything that has a discounted cash flow I can value, and gold, inherently doesn't. As you alluded to, I think a lot of the rise in the gold price is Russia and China and the other central banks buying so much gold. I think it's been a very overcrowded trade. What it is not indicating is a concern about inflation, because that's not reflected in other markets. It's not really even showing geopolitical destabilization. So it's an odd situation. I think we're living in a world where the money supply is increased, and so it kind of makes sense that gold adjusts for that in some way. But the real thing I would say is gold doesn't seem to be the diversifier that it has traditionally been.
So what is the diversifier? Is it a multi-country asset allocation?
Well, everything is more correlated, so very hard to diversify. So the quick answer to your question is yes. Everybody seems to be overweight in the United States, and within the United States, overweight the Mag 7. So I am certainly jumping up and down, trying to push people to invest broader than the United States, and certainly broader than the Magnificent Seven. And that, you used to do that, one way to do that, you thought, was to invest in indices. But now indices are so concentrated that you actually would get much more diversity from an active manager or somebody that can,
as opposed to passive,
as opposed to these passive strategies. So then, yes, you need to diversify by country. You need to diversify by asset class. I think that fixed income, as interest rates come down, probably need to have fixed income, but also increase your duration. We are trying to advise clients to be in some private assets. Here in India, it might make sense to be in private fixed income or private equity or private real estate. Real estate is the one thing that has not gone up so much globally, and maybe an asset, especially if interest rates continue to drop, could do well, but it won't do well if the economy isn't doing as much.